What if I told you that one three-digit number quietly decides where you live, what job you get, how much you pay for healthcare, and whether your life moves forward or stalls completely? Most people think credit scores are about responsibility, a neutral tool, a fair measurement. But here's the mystery. Why does a system created to measure lending risk now control nearly every aspect of modern life? And more importantly, why was it built this way from the beginning? This isn't just a story about money. It's a story about trust, power, data, and how a private number became a social passport. To understand how we got here, we have to go back to a time before credit scores existed at all, when your reputation wasn't a number, but a judgment made behind closed doors. And that system was far more personal and far more dangerous than most people realize. In the early 20th century, there were no credit scores, no algorithms, no databases. Credit decisions were made by people, not systems. If you wanted to borrow money, a lender didn't check a report, they checked you, your face, your accent, your neighborhood, your reputation. Banks kept handwritten ledgers called credit books. Inside them were notes like, "Reliable family man drinks too much. Foreign background wife seems irresponsible." These weren't financial assessments, they were social judgments. Credit was local, intimate, and deeply biased. If you didn't fit the right profile, wrong class, wrong race, wrong social circle, you didn't get access. Not because of risk, but because of who you were perceived to be. This system worked for banks, but it created chaos for a rapidly changing economy. By the 1930s and 40s, the United States was transforming. Cities were growing. People moved constantly. Consumer goods, explode cars, refrigerators, radios. Suddenly, lenders were dealing with millions of strangers. They couldn't rely on personal familiarity anymore, and that terrified them, because lending isn't just about money, it's about control over uncertainty. Banks needed a system that could replace human judgment scale nationally, reduce bias at least on paper, and protect profits during economic shocks. The Great Depression had already shown what happens when trust collapses, so the financial system went searching for something revolutionary, a way to turn human behavior into data. The earliest versions of credit scoring didn't come from banks. They came from retail stores and mail-order companies. Department stores wanted to know who paid on time. Landlords wanted leverage over tenants. They began tracking patterns, payment delays, job stability, address changes. Family status, not just what people earned it, but how they lived. In 1956, engineer William Fair and mathematician Earl Isaac founded a company with a radical idea. What if lending decisions were based on statistics instead of personal judgment? They called it Fair, Isaac and Company, later known as FICO. Their pitch was simple. Algorithms don't discriminate. Numbers don't lie. Data is objective. Banks loved it, not because it was fair, but because it was efficient. Credit scoring allowed lenders to approve or deny loans, instantly reduce labor costs, expand lending without knowing borrowers personally, shift responsibility away from human decision makers. If something went wrong, the system, not the banker, was blamed. But this is where the first crack appeared. Because the data used to train these models came from a biased world, credit scoring didn't erase discrimination. It encoded it. If historically certain neighborhoods had fewer loans, the model learned that. If certain jobs were unstable due to systemic inequality, the model punished that. If certain communities were excluded before, the data confirmed they were risky. The algorithm wasn't judging individuals. It was judging patterns shaped by power. And once those patterns were automated, they became invisible, unquestionable, objective on paper. By the 1970s, credit scoring had moved from optional to essential. Lenders who didn't use it were seen as reckless. And that's when the system crossed a critical line. Originally, credit scores were meant for one thing: loan approval. But institutions quickly realized something powerful. A credit score wasn't just predictive, it was disciplinary. People changed behavior to protect it. They paid bills on time, not out of stability, but fear. They avoided risks not because they were unsafe, but because the score might drop. So other industries took notice. Employers began checking scores. Landlords demanded them. Insurance companies priced policies based on them. Utilities used them for deposits. A financial tool quietly became a social filter, and most people never consented. Here's the illusion the system sold. If you behave correctly, you'll be rewarded. But what does correctly mean? Stable income during unstable economies, consistent payments during medical emergencies, low debt while wages stagnate and costs explode. The score doesn't measure morality. It measures compliance with a system designed around debt. And that's the twist most people miss. Credit scores didn't just measure financial behavior, they reshaped it. By the late 1990s and early 2000s, credit scoring had become infrastructure, invisible, untouchable, assumed necessary. But beneath the surface, something dangerous was building. Easy credit, over-levered risk, disguised as safety. The system designed to prevent collapse was quietly amplifying it. And when it finally broke, the consequences would reveal the true cost of turning human lives into numbers. But to understand that breaking point, we need to follow credit scores into the age of mass debt and financialization. That's where the real control begins. By the early 2000s, credit scores were everywhere, but almost no one questioned them. They were treated like gravity, invisible, unavoidable, and permanent. Banks believed that had solved risk. Investors believed debt had been tamed. Governments believed markets could regulate themselves. And ordinary people believed one dangerous idea, that a higher credit score meant safety. But credit scores weren't reducing risk anymore. They were hiding it. Lenders no longer cared if borrowers could truly repay. As long as a loan could be packaged, scored, and sold, the risk disappeared at least on paper. This was the moment credit scores stopped being a tool of evaluation and became a tool of justification. Here's what credit scoring made possible. Subprime borrowers could be labeled manageable risk. Loans could be bundled into securities. Risk could be sliced, rated, and sold globally. Responsibility could be passed endlessly downstream. Credit scores allowed lenders to say, the model approved it, not we approved it. The system did. Mortgages were handed out to people who didn't understand the terms. Adjustable rates were disguised as opportunity. Debt was marketed as freedom. And credit scores played the role of moral shield. If borrowers defaulted, the blame wasn't systemic. It was personal. You shouldn't have taken a loan. When the housing bubble burst in 2008, something shocking became clear. Credit scores did not predict collapse. They accelerated it. Millions of people with acceptable scores defaulted at once, and entire financial institutions imploded. Why? Because credit scores measured individual behavior, not systemic fragility. They assumed the world would remain stable. Jobs would exist, healthcare costs wouldn't explode, housing prices would rise forever. The model had no answer for mass unemployment, no answer for frozen credit markets, no answer for panic. And when everything collapsed, the fallout exposed the truth. Banks were bailed out, institutions were stabilized, markets recovered, but individuals, they lost homes, savings, years of financial mobility. And then came the final insult. Their credit scores collapsed too, not because they suddenly became irresponsible, but because the system they trusted failed them. Missed payments during unemployment. Score destroyed. Foreclosed during a crisis you didn't cause. Score destroyed. Medical debt after layoffs. Score destroyed. This system punished people for surviving a collapse it helped create. After the crisis, politicians promised reform, transparency, fairness, consumer protection. New laws were passed. New disclosures were required. New oversight agencies were created, but the core of the system, untouched. Credit scores remained proprietary. Algorithms remained opaque. Errors remained common and difficult to fix. Even today, millions of people have incorrect data on their credit reports. And correcting it can take months or longer. Why? Because the system isn't designed for accuracy. It's designed for leverage. Every proposed fix runs into the same wall. Makes scores more inclusive. Gives risk increases for lenders. Reduce their influence. Gives entire industries lose control. Replace them entirely. Gives a debt economy collapses. Credit scores are no longer a tool. They're infrastructure. They prop up housing markets. They price insurance. They shape labor access. They enforce discipline without direct force. And most importantly, they shift responsibility downward. Systemic instability becomes individual failure. Now look around today. Buy now pay later systems, fintech lending apps, AI-driven credit decisions. Alternative data tracking social behavior. Your phone bill, your subscriptions, your location patterns, your digital footprint. all becoming credit signals. The logic is the same as it was decades ago. Turn behavior into data. Turn data into judgment. Turn judgment into control. The only difference: the system is faster, more invasive, harder to escape. Here's a statistic most people never hear. A higher credit score does not mean financial security. It means consistent participation in debt. You can have no savings, massive exposure to shocks, one emergency away from collapse, and still have an excellent score. Meanwhile, someone with cash reserves, low spending, no debt, can have no score or a bad one. The system doesn't reward resilience. It rewards predictable repayment behavior. Credit scores don't measure trustworthiness. They measure obedience to a financial structure. They reward regular payments, stable employment, long-term borrowing relationships. They punish volatility, self-reliance, opting out. That's why they feel less like a financial tool and more like a social leash. Takeaway number 1. Credit scores were never neutral. They were built to solve lender uncertainty and not human well-being. Takeaway number 2. Automation didn't remove bias, it hid it. Old inequalities were converted into data and made permanent. Takeaway number 3. Control works best when it feels voluntary. People self-police behavior to protect a number they didn't design. As systems move toward a year-driven risk scoring, one question becomes unavoidable. If a number already controls housing, jobs, healthcare, and mobility, what happens when it starts controlling speech, movement, or access itself? Credit scores were the prototype. What comes next may not even call itself credit. If this video changed how you see credit scores,